What type of economic recovery should you be planning for? Trade credit insurance and the latest business bounce back and CBILS loan performance. All in this week's Business Finance Bulletin. With lockdown restrictions starting to be lifted, what should you do about planning for an economic recovery? Well, all the economists and the government departments are now starting to think ahead for the remainder of 2020 right up to 2022 as regards what recovery will look like. Now, the Bank of England has already said that they're anticipating a 25% drop in GDP for the second quarter of 2020. And the Bank of England is very much expecting a V-shaped recovery. Now, what is this V-shaped recovery? Well, as the name suggests, is in the shape of a V. We've had a very sharp drop and they're anticipating a very sharp recovery upwards. They anticipate that businesses and individuals have been saving a lot of cash over the last couple of months, and that as soon as the restrictions are fully lifted, there's a lot of pent-up demand in the market and that recovery will be quite swift. However, there's another school of thought that the recovery will be more in the shape of a W, a very sharp drop, which we've experienced already, a sharp recovery, but then another drop and then another sharp recovery. So what's driving this school of thought about this kind of double dip? Well, there's two things. First of all, Brexit. Yeah, and I haven't mentioned that word for a long time. That's starting to come back on the agenda. It does seem the noises in the marketplace that we may be faced with a no-deal exit at the end of December 2020. And if that happens, that could potentially destabilise the market again. So we'll have that second drop. Also factoring into this is insolvencies. Now, there's always a wave of insolvencies going into a recession when the weaker companies fall over very quickly. But there's always a second wave of kind of insolvencies 6 to 9 months after recession has ended. And this is where businesses are now back in growth mode, but simply run out of cash to fund that growth and they fall over. Now, they run out of cash because they haven't got enough cash reserves and they can't access finance to fund working capital. So these two factors could actually lead to this second dip within the next 12 months. So what should you be planning for? Well, I would be planning for worst case scenario. Assume that the worst is going to happen. And as I mentioned in my previous bulletin, now it's all about cash. Hoarding cash. I remember an interview I heard many years ago with the industrialist John Harvey Jones, and he was saying in times like this, businesses should be running for cash, and that's exactly what you should be doing. So go through your forecasting process and assume worst case scenario, and you won't go far wrong there. And remember, it's now all about cash. Another aspect of ensuring a strong economic recovery is making sure that businesses have confidence to trade with each other. Now, more often than not, when businesses are trading with other businesses, often credit terms are offered, whether that's 30, 60 or 90 days. But of course, offering terms implies that you have confidence that the other side is going to settle your invoice. And this is typically where trade credit insurance comes into play. Some businesses, they want the comfort that if an invoice is not paid, they can go back to their trade credit insurance provider and say, hey, this invoice has not been paid. Can I claim on my insurance, please? Now, factoring companies and invoice discounting companies also rely on trade credit insurance as well. So it's an important part of ensuring the continuation of the supply chain in the economy. Now, the government has realised that confidence has been shot to pieces over the last couple of months, particularly in the trade credit insurance market, where it's really hard to get good insurance at the moment. So the government has recognised this risk and has now come up with a trade credit reinsurance scheme. This is a £10 billion fund which will give the trade credit insurance kind of comfort that they can continue offering insurance policies. So if you want to start offering credit terms again and you want to lay off that risk, have a look around for a good trade credit insurance company, and hopefully that confidence level that you need will be backed up by firm support, allowing you to start trading safely with your business partners. Let's close this week's bulletin with my regular look at what's going on with the government loan support schemes, the bounce back loans, the CBILS and the large CBILS scheme. The latest figures have been released by UK Finance and HM Treasury, and they show that since the schemes started, the total amount of money now lent out has come to £31 billion, and that's an increase of £4 billion in 1 week alone. In terms of total loans approved, well, that now stands at 745,388, and that's an increase of just over £94,000 in the previous 7 days. So you can see still a lot of activity going on there. Now let's break that down first of all into the bounce back loans. Now, the bounce back loans, the total amount lent so far is £21.3 billion. Number of loans approved 699,354. Number of applications received 873,192, and that's an approval rate of 80%. So we can see still strong activity going on there. Now what about the other CBILS schemes? This is one for loans £50,001 and above. Well, the total amount put out the door there comes to £8.9 billion. Loan applications approved of 45,843, with 89,724 applications received, being an approval rate of 51%. Now both those approval rates are holding quite steady at 80% for bounce backs and the 50-odd% for CBILS. So really settling into a good trend there. So there's still plenty of money available. The log jams are starting to release, and banks are really pushing this money out quickly, particularly the bounce back loans. If you haven't applied for them yet, please do. But I mentioned in my previous bulletin, make sure you kind of use this money wisely. Don't go using it to pay off debt unless you're 100% certain that you don't need that cash that's been released. So there we are, some really good news about activity levels still holding up with those government support schemes. Well, that's it for another bulletin. As ever, I hope you enjoyed watching it. And if you did, please don't forget to give it a like and a share. So that's it. Look forward to being with you next time. In the meantime, have a safe, profitable and healthy week.